Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and this show is syndicated on the newly launched Financial Advisor TV. To learn more about Financial Advisor TV, please visit financialadvisor.tv. My guest today is Tony Davidow, and we're going to talk about some of the things that he wrote about in his new book, Goals-Based Investing. Tony, thanks so much for coming on the show.
Jay, thanks so much for having me, and thanks for taking the time to actually read my book.
It's a great book. And for old dogs like you and I who are SEMA charter holders and investment nerds, this book is a home run. So I want to get into some specifics in one particular part of the book. But first, why don't you give listeners some context about why you wrote the book and what they would gain from it?
Yeah, and I would say that although it only took me a couple months to write the book, it's really kind of a recollection of a 35-year journey as I've watched the industry evolve. And what I try to do is, we need to learn from our history to evolve appropriately. So I do share a little bit of the history of the business, how it's evolved, and how I think change has accelerated over the last couple of years. And I'd argue the next 10 years are going to be dramatically different than the last 10 years. I think it's going to be different in the way that advisors serve clients, the investments that they bring to bear. I think the way that clients engage and really think about the advisor's value proposition is changing now. And I think it will only change more rapidly as we go into the future.
Yeah, I love it. It's changing so fast. It's almost difficult to keep up with. Your book does a great job for setting that context and what advisors need to be thinking about as they look towards the future, which, Tony, it's really the part of the book that I wanted to dive into for our audience, if that's okay with you. So in there, you talk about the future of advice and you list 10 predictions. Let's go through them, and I'd love to get your thoughts. So your first prediction is that a demographic shift, younger and more diverse, is coming. What do advisors need to pay attention to?
I think it's paramount for the success of our industry, Jay. Unfortunately, too much of the industry looks like you and I, old white guys. And the reality is, I think we need to do a much better job embracing young millennials who see the world differently. We need to bring more women and minorities into practices. We need to do a better job mentoring them so they're equipped to take on leadership roles in these organizations, whether they be large firms or small firms. And I think at the end of the day, clients want to see people who look like them, people who understand some of the things that are unique to being a millennial. You and I grew up in a different sort of generation, and I have two millennial daughters. They're very smart, they're very diligent in what they do, but they're not going to engage an advisor in the way that they did of our generation. They're going to use technology more. They're going to ask a lot of questions. They're going to be passionate about things like social responsible investing. So if we're not meeting them where they are and how they engage, I think there's an opportunity being missed. And unfortunately, I think many of those advisors may wake up and find out that the practice is, obsolete, or it's at least losing traction and relevance.
Tony, to go a little bit deeper on that, it's been an issue in our industry since its formation.
Yeah.
I think the challenge, if you look at people who got into the industry when we did, I started in the 90s. I started in a bullpen at Dean Witter, and the only way you were successful is if you were great at sales. Nothing else mattered. And that's obviously changed, not only with the way millennials want to work and do market, but with the fact that those old tactics aren't necessarily what works. Where I find, as I look at the industry, the biggest gap is getting people onto teams and getting them trained. And then from the other side, those same advisors having the same experience that the Gen X and Boomer advisors had in terms of, it's an old term, but paying their dues, learning how to do all this stuff. How does the industry bridge that gap?
Yeah, I think we need to do a better job mentoring. You're exactly right. And I think part of my motivation in writing the book was to share this journey that you and I and others have been on, which is, the industry kind of evolved from selling stocks and funds, right? We were selling a product to engage in clients. And I think it's instructive to understand, how advisors need to evolve, but also how clients perceive us. So in the book, I interject a couple case studies with ultra high net worth families that I've dealt with over the years, because I think it's instructive to kind of think about how the world sees us and what they view our value proposition. I think we need to tell that story to the younger generation so they actually understand it, because it is more than selling a product, and it is more than just calling and I've got something to sell you. It's really engaging large families in particular in a different way than we ever have, and expanding our capabilities beyond just the investment or beyond the portfolio to think about what are the trust and estate issues, what are the family dynamics. You and I have been in this industry for a long time, and if we have clients who are at a certain age and all of a sudden they get older, one of the things the industry's grappled with for years is how do we make sure that we have connectivity to that next generation in the family. It's the same sort of thing that we need to think about with our practices. How do we get those younger advisors, learning the ropes, learning all the things that we've kind of learned the hard way over the years, so it's part and parcel of their value proposition, so their skills are better aligned. And I think part of it is, organizations like the Investment and Wealth Institute, or what you and I grew up understanding to be INCA and Kaya and CFA. And I've challenged those organizations. They need to evolve their curriculum to evolve to meet advisors where they are and what are the challenges that they face, much of which is beyond the portfolio.
Yes. Yeah, well beyond the portfolio. It's funny. I remember when reaching back to the next generation meant connecting with baby boomers. Oh, man. All right. So let's talk about the second prediction you have in your book, and that is there will be more dedicated teams. What do you mean by that?
Yeah, I think it's really tied into the first discussion we just had, which is high net worth families in particular are expecting so much more than just a portfolio allocation. What they want is they want an expert who really understands the trust and estate issues. If they just sold their business, they might have a large concentrated position, so they need somebody who understands what's the disposition of dealing with large concentrated positions so we don't incur huge taxable events. It's understanding taxes in great detail. And I think to expect one advisor to be an expert in all, it's pretty daunting. So I'd argue practices need to evolve. They need to have more expertise, more specialization. The other thing is, from a client perspective, I think a client feels more comfortable thinking that there's a team of people working on my behalf, as opposed to one practitioner who may be vulnerable, if he or she gets older in age, or he or she decides that they want to retire at some point in time. So I think it also provides a much more durable business model.
Yeah, without a doubt. And speaking about building durable business models, your third prediction is around technology as an enabler in a practice. What are your thoughts on that?
Yeah, and again, we just had some challenges with our technology for this call today, which I apologize for. You're an expert, but we shouldn't be fearful of technology. We need to understand technology, and if you and I go back to our early days, technology helped us do a lot of things. Technology helped us do more efficient asset allocation modeling. It allows us to screen more managers efficiently to do an effective manager search over time. So we need to understand that technology provides scale, provides the ability to do mean sort of tasks in a more efficient way. It doesn't replace advice. And one of the themes throughout my book is we need to embrace technology. Otherwise, technology is potentially going to replace some advisors. This robo offering is real. And if an advisor if they don't figure out how to use technology as a tool to make them better, I think some clients will gravitate to a robo offering, especially if they don't perceive this broader set of capabilities beyond the portfolios. They're going to gravitate to some sort of robo offering, which can now do financial planning or asset allocation modeling. So to me, embrace the sort of things that technology can do for us. What it will never replace, what a robot or a technology isn't going to be replace, is the ability to really understand clients, right? The personal skills that we develop, the ability to see empathy and show empathy with our clients, the ability to see how clients react to questions, not just checking the box, but the way that they respond to things, the way that they think about risk, the way that they feel when markets are volatile. Those are human things. And I think those human elements will never go out of style.
Yeah. When an advisor expresses concern about robo-advisors, I ask them how many of the clients they've worked with when one of the spouses passes away would have been happy sitting there with an iPad getting advice on what they needed to do next. You're spot on. And I got to tell you, in my consulting practice, I really push on advisors when they say something like, well, I'm not going to learn that new technology, which is fine if you're going to retire in the next 3 years. But if you want to be relevant and have a long-term sustainable business, you really do have to embrace technology. I find there's still pushback, especially among the older Gen X and late boomers. Do you find that in your work?
Yeah, it's stunning to me because, again, I think that we just need to embrace the fact that the world is changing and we can't do everything. There are a lot of mean tasks that I think technology can definitely provide efficiency and scale to the practice. But you're right that so many people feel threatened by change at all. Change can be threatening, or it could be this incredible opportunity. By the way, this point also ties into the first point, which is maybe this is the opportunity to get those younger millennial advisors, teach them the ropes. They understand technology. They can customize the technology. They can customize the way that we engage clients. By the way, what you and I are doing here, I think more and more clients are saying, I don't really need to come into your office. Can we just set up a Zoom call? We figured out over the last couple of years that this actually does work. It doesn't replace the human intervention, but it's an enabler. So maybe rather than having in-person meetings once a quarter, maybe one of those is in person and the others are just a quick checkup via a Zoom call. Well, that's technology. That's an enabler. That provides a lot of efficiency.
Yeah, without a doubt. All right. So the fourth prediction in your book is around goals-based investing and it becoming the norm in our industry. Tell us, what do you mean by that?
Yeah, and it's something I've certainly written about and spoken about probably for the last decade or so. And as you and I were talking about earlier, it doesn't suggest that modern portfolio theory is obsolete, or it doesn't suggest that modern portfolio theory hasn't served us very well over the years, because I would argue it really has. But I think there's a couple flaws with modern portfolio theory. One of those being that there's this built-in assumption that all of the inputs that we put in the models are static and they remain the same. And of course, we understand that returns are not static. We're living in an environment now where the projections are equity returns over the next 10 years are going to be substantially below where they have been over the long run. Bond yields are at near generationally low levels, and we still have $18 trillion of negative yielding assets around the world. Correlations, like it or not, have been increasing. And lastly, we need to figure out how to deal with this terrible sort of phenomena that you and I are familiar with, but I fear a lot of advisors aren't, and that is inflation. Modern portfolio theory doesn't necessarily solve that if we use stale inputs, right? We have to have current inputs, and we need to understand the environment we're in and how we solve for that. The other sort of flaw with modern portfolio theory is this built-in assumption that clients will always make rational decisions. I don't know about you, Jay, but I don't know too many clients that are rational, especially when we get market volatility. Everyone's rational when the market is going up and they say, I want to maximize return. Everyone feels very differently when it gets choppy. So to me, the natural sort of pivot, and I'd argue goals-based investing, is really the marrying of modern portfolio theory and then just understand some of these built-in behavioral biases that clients have. And it's marrying those together to change the utility function to say, what we're really solving for is what is the specific goal that I should be solving for. And if you're dealing with high net worth families, I'd argue potentially you're dealing with multiple goals, right? There may be a goal for the personal account, there may be a different goal for the family foundation, and maybe for the trust for the children and the grandchildren, there's a different sort of goal. So to me, goals-based investing allows us to pivot and align for what are we solving for, track the progress on an ongoing basis, and we do it at a per entity level rather than thinking one family unit is one homogenous sort of set of goals.
Yeah, and really that is the core of the book. That was my takeaway, is coming up with a different framework for solving problems for high net worth families. For podcast listeners, you can learn more about Tony's book by visiting tdavidowconsulting.com/book. Tony, the fifth prediction is around ESG and direct indexing. What are your thoughts around what we're going to see evolve over the rest of this decade?
Yeah, like you, I'm sure that we've had a lot of people question: is ESG kind of a fad? What's the difference between ESG and SRI? But I think we've got past the point of this being a niche sort of opportunity for women and millennials. I think the reality is, if you look around the world, Um, Sustainable investing, which I'm going to call the big umbrella, sustainable investing today is roughly a third of all the assets in the world, and more you're seeing it kind of built into the way that clients are asking questions of advisors. Do you incorporate some of these practices? I think it's instructive maybe to go back and just say SRI, which you and I recall in the early days, was negative exclusionary screening, and it was a natural sort of reaction to apartheid and sin stocks and some of the things that clients didn't want to have in their portfolio. ESG is relative screening, which is saying I want to weight and orient my portfolio so it reflects my values and it can be more representative of the market. I'm not excluding things, but I'm providing the highest weighting to those companies that are doing good. And then impact investing, which is also under that umbrella, I'd argue is more private equity, where we actually have the ability to impact changes in the portfolio. But I'd argue broadly, those are not niche strategies. And I've certainly seen a lot of studies, I suspect that you have as well, that the studies seem to point to the same sort of thing. If you ask clients overwhelmingly are saying, I want education on ESG. I need to understand it. I need to understand how it fits into my portfolios. And they're saying, I would like my advisor to provide that advice. Overwhelmingly, the same sort of studies are saying, financial advisors are saying, I don't hear that from my clients, therefore I don't want to learn it. It's too hard for me. It's different. Maybe it's a niche strategy. Maybe it's not going to be here tomorrow. So I'd argue there's a little bit of a disconnect and attention. I think advisors who embrace ESG, they build it into their process. They think about how it works with clients. And it may be they don't incorporate it with all of their clients, but at least engaging them and having a discussion about, are there passions and purposes that we should think about incorporating into your portfolio? You've just changed the relationship you have with your client. I'd argue it's not something we can put in the back anymore. We need to bring it front and center, engage our clients about it, and have at least a few options at your disposal that can be more socially responsible oriented that they can bring to clients. I think it's a different way of distinguishing your value proposition. It's not something advisors should fear. It's something advisors should embrace.
And then what are your thoughts around direct indexing?
Yeah, and I kind of link those together because I think direct indexing is really exciting. And again, this is a great technological advancement. You and I have been big believers over the years of ETFs, and ETFs were really just a more efficient way of packaging solutions. But now with things like fractional shares and technology that allows us to more effectively screen these things, couldn't you work with your clients, express their views and preferences in the portfolios, and you develop a direct indexing portfolio? I think that's the future, and it's exciting. The other thing I think is maybe it gets the younger generation more excited about investing, because I know my kids, and my kids are these typical millennials that we always hear about. They care about the environment, they care about doing good and all of that, but they also feel like, gee, investing is not for me. And they're like, well, why would I bother to do that? I have you to advise me on what to do. But I think if we can get them excited about investing because they're aligning their purpose and their passions and their portfolios, all of a sudden we're now teaching the next generation to invest the right way, as opposed to what we see some of them doing on their own, which is, just chasing ideas and not really thinking about, is there a fundamental valuation attached to it? So I think direct indexing could be really interesting for us. Again, it's something that I think we should lean into to understand. It may not be for everyone, but I think advisors should at least understand what it is and how it may fit into their portfolios, and in particular with some of their smaller clients or clients that may be more focused on expressing specific views and preferences.
Yeah, I'm a big believer in direct indexing. If the advisor understands how it works, the value proposition, and presents it correctly, I see it as a game changer. I'm surprised it doesn't get more attention around the advisors that I typically interact with. It also does require a little more work for the advisor, a little more education, as opposed to just outsourcing it to somebody else. But Tony, I agree, direct indexing is a game changer. The next prediction is the bifurcation of advice between robo and the actual wealth advisor. What are your thoughts on what's going to change there?
Yeah, and I cite some of the McKinsey does some great research, and I cite one of the reports that they came out with, which, if we think about where the high net worth market is going, it's become very confusing. Everyone wants to pursue the high net worth investor. There's a lot of competition there. It gets very, very confusing. But a high net worth investor doesn't want a cookie cutter solution. And I think more and more they're demanding very customized solutions. So if you're an advisor focused on the high net worth market, or you're focused on the ultra high net worth market, I think you need to have a deep, dedicated team, right? It's all the things that we talked about earlier. You need to have somebody who's an expert in trust and estates. You probably need to have taxes or tax management kind of built into your practice. You need to think about the role and use of alternatives, which is obviously one of the big messages throughout my book. We need this expanded playbook. So it really begs for a deeper team. One person can't be an expert in all of it. And I think as we think about that high net worth market, they're going to gravitate to people who have all those capabilities in one place. I think at the lower end of the market, for those who either smaller clients or clients who don't perceive the value proposition coming from an advisor, they're going to gravitate to robo. They're going to gravitate to low cost, because if they don't see value, cost is the only determinant, and all of a sudden they're going to be going downstream. So I do see the market itself start to bifurcate, where at the high end of the market, you're going to have these really super teams who develop very customized sort of solutions. It's very customized at the high end and very cookie cutter at the low end. And there's this kind of muddled sort of middle, where I think maybe those advisors need to figure out, how do I serve those clients? Are they kind of a combination of maybe a robo and then some level of customization? But I do think the high end of the market is definitely demanding much more customization.
Yeah. So the rise of the super team that you talk about, I found interesting. A good portion of my client base are the lone wolves, people that broke away from a wirehouse. They built a practice, they leveraged technology. And if they've broken out in the last 10 years, like, it's starting to become overwhelming for a lot of people. How does the concept of and the structure of a super team work in the independent space versus working inside of a wirehouse?
Yeah, I think more and more we're seeing that. I think part of it is, just the reaction to the demand, right? There's so much demand. The advisor that you just talked about, right? There's so much expected of them. They really need to figure out how do they diversify their practice, right? I mean, diversification is what we're all about here. We need to diversify our practices as well. We need to have different sort of team members who have different skills and can be additive to whatever it is that we're providing to clients. I'd argue that clients are really asking for it and demanding more of a team approach too, because I think they're seeing through. It says, if I can get a team of 5 to 6 people working with me over here at this RAA, and I know here it's really Bill and he's got a team of people, but they're really more administrative in nature, I think clients feel much more comforted thinking there's a team dedicated working on my behalf. So I think clients more and more are demanding it. I understand it is a threat to a lot of the senior advisors, probably a lot of the same folks that you and I have grown up in the industry with. They become very successful, and when you're successful, it's difficult to change. But I think for a lot of them, they're starting to realize they can't keep up. They can't grow their business, right? Just keeping up with the business is a full-time job. So how are they going to grow their business? How are they going to think about succession planning for the next group of professionals that are going to take the business over? Because at some point they're going to retire. I think too few advisors are thinking about succession planning until it's too late. They need to think about it earlier on. So to me, it's good for the clients, it's good for the advisor, and I think it's really good for the industry, because it does get back to that first point about if we can bring younger professionals and diverse professionals into the business, that's a really good thing.
Yeah, way, way, way too few advisors have thought about their succession plan. And then usually when I get called in is when there's a problem and they've got to solve that issue quickly, and it doesn't work out well for the clients, most importantly, or the advisor's family. So it's a big, big issue for sure. You also, in one of your predictions, talk about the need to right size a practice. Now, I am such a huge advocate, and we're in an echo chamber here if people are longtime subscribers, but give us your thoughts on right-sizing your practice as a financial advisor.
Yeah, and early in the book, I try to frame the difference between the private wealth business, and I spent many, many years at Morgan Stanley. For a good portion of that time, I worked in the private wealth business, working with private wealth advisors who were dealing with clients, 20, 50, $100 billion families. And they had practice sizes of 40 families. And obviously they got very deep with those families. I'm not suggesting that's the right size for everyone. But I think to the example that you were just illustrating, if you're an advisor and you have 500 clients, you can't really serve 500 clients well. You have to figure out what the math is. I think the other reason to bring on more professionals is it does give you more bandwidth. There are certain rote things that can be handled by your administrative staff, but real client engagement and building portfolios and understanding when a client is going through a change of circumstance. I think it requires a dedicated team. So I think there's really two dynamics going on here. One is there is a need for more bigger teams, diverse teams, more teams with senior professionals. And then I think if you go through that exercise, you need to determine what is the optimal amount of clients that you can comfortably serve, right? I mean, you can have 500 clients, but my guess is 450 to 500, wherever they are on that rung, really aren't getting a whole lot of attention. Would they be better served being pushed off to a younger advisor? Maybe that's the opportunity for them to really learn the business the way that you and I did in the early years. But I do think that is one of the challenges for advisors, and it encumbers their ability to grow because they're so forced to deal with this clunky structure that they've created. So I know it's a tough thing to do, and I suspect you can be of real value helping them navigate through this process. But it is something that when they right size their business or when they start to shed some of those smaller, less productive clients, all of a sudden they're liberated to grow their business. And I think what they find is they can actually grow by shrinking.
That's right. And there are lots of great consulting and coaching programs out there that can help advisors do it. And the reason there are so many is there's a need. There's a market for it because advisors' businesses really have gotten out of control, generally speaking, along these lines. But, Tony, it's hard for advisors, especially in small towns, to go and get rid of those smaller clients. And it really speaks to one of your earlier predictions, the rise of these super teams and the ability to bring in younger and a more diverse staff to go and help service everybody. And it really kind of all melds together there when you think of some of your predictions. The last one I'd like to address is the rise of advisor ratings. Tony, what is that going to look like?
I was trying to be provocative, and I thought that would be the one that would get a lot of people's attention. So imagine, rather than we have a lot of advisor lists now, but we all know they're primarily based on assets and firms nominate people. But imagine you had an app, like a Yelp-like app, and you could rate your advisor based on the diversity of their practice, their investment acumen, how have they helped you through a difficult period of time, maybe some of these softer skills. I could see a Yelp-like app just taking off, but it's not being populated by the advisor or their firm telling you how they should be perceived, but by the client saying, this is how I think my advisor or my team of advisors are serving me. I think that could really be a game changer. I was talking to somebody about it, and he instantly thought, well, gee, this would be great because the regulators for years have been saying, we need to have some sort of way of differentiating between advisors. I'd rather not have the regulators do it. I'd rather not have the firms nominate and say, these are my best advisors because they do the most business. I think the most impactful and the most meaningful would be if clients could, in fact, rate their advisors and they could say, I think they do this well, they don't do this well. And it would make it a lot easier if you then were selecting, just like if we want to go to a restaurant, what do? We look at the reviews. This one has great food. It's a little pricey. Well, if I don't mind paying the price, that's fine. I know I'm getting a good experience here. I think we're going to start to see that. And I think it could really take off, and I think it'd be really valuable. The challenge for advisors then is to anticipate this. How do your clients perceive you? How would you be rated in your Yelp-like app? What would they say about you? Now, there's a proactive step, and this is something I do talk about, which is, I've always talked about the value of an advisory board. And in my book, I talk about the fact that I formed an advisory board when I set up my business, and they were, in fact, the group that encouraged me to write my book. But I've always said for advisors, it's a great value to have an advisory board too, because you want them to be a sounding board. How am I coming across? What am I delivering that's good? Where can I improve this, my service, my investments, whatever? But the other thing is you can also then, by bringing them in, they feel vested in you, right? They're vested in you. They're going to help you be successful, and they're going to introduce you to like-minded people. I think the same thing, if we think we're going to eventually evolve to advisor ratings, maybe we could have that same sort of sounding board to say, how would you rate me on these areas? What can I do to improve my perception? How can I be a better advocate for you and what you're trying to do with your pool of money? There are a lot of things that I think we could do proactively. But although that seems provocative, I think if we think about it, it actually seems pretty simplistic. It wouldn't have to be a very complicated sort of app to do that. And I would imagine it would be of great value. And I think if it was out there, you'd start to see a lot of traction.
Yeah. Just the thought exercise that an advisor could go through now of what would that look like if it was in place could really have and generate some insights and changes they can make for their practice heading into next year. Tony, I appreciate you coming on and sharing your thoughts on the future of advice. I want to give you an opportunity to talk about your book for just a minute. So, Tony, what would an advisor learn by purchasing a copy of Goals-Based Investing?
Yeah, and I think maybe it's important to say why I wrote the book. So I've spent 35 years running around the country working with advisors, great advisors, and working with a lot of high net worth and ultra high net worth families. But candidly, I haven't ever seen a book that is really geared towards advisors. And the advisor in particular that I'm focused on are what I refer to as lifelong advisors. Jay, folks like you and I who have invested in ourselves. We love change. We love, investing in ourselves by taking advanced education at the SEMAs or the KAYAs or the CFA associations because we know the world is ever changing. And I really wrote it with that advisor in mind, just to give them the opportunity to kind of, one, understand the journey the industry has been on, tease them a little bit about the future, but also in there, I provide these real life examples and case studies to help illustrate maybe how clients think about us, or maybe how we could think about pivoting our business and our value proposition to be more aligned with the way that clients, I think, perceive us. I think the industry is changing quite a bit, and as much as you and I suspect all of the people who are on this call are comfortable using the language that we often fall into in this industry jargon, I think it's confusing to clients. And I think if clients don't really see the true value proposition of an advisor, they may be tempted to default to this robo low cost option because they don't see all the things that we do. They don't see all the things that we do beyond the portfolio. They don't understand these behavioral coaching exercises that we go through every time there's market volatility, or how we prepare clients for the inevitable bumps in the road along the way. So goals-based investing, as the name suggests, really frames all of this to saying we need to change the way we engage clients. We need to establish realistic goals and objectives in the beginning, monitor the progress to those goals over time, and ultimately make sure that we don't fall into the trap that our clients do, which is chasing the bright, shiny object, right? Everyone wants to have, NFTs or Bitcoin or whatever the new shiny object is today, without truly understanding how does it fit in the portfolio, what role does it play, and ultimately, how does it help me achieve my clients' goals and objectives over the long run? So I really wanted to provide something written specifically for your audience, Jay, and the people that you and I have grown up in the industry, those who have really embraced change, understand that our value is constantly evolving and our value is much more than just the portfolio.
Awesome. Tony, thank you so much for coming on. Podcast listeners, you can go and visit tdavidowconsulting.com/book to grab your copy. And YouTube viewers, you can click the link in the show notes. Tony, thanks for coming on.
Thank you so much, Jay. Really appreciate it.